What's going on, everybody? Jeff here. Welcome back to the channel. The downside move continues after a brief consolidation period yesterday after Friday's massive sell-off. We get that continued move, the SPY breaking under that $400 level. I want to give you a brief update on what to expect over the next week, week and a half, ahead of the jobs report and ahead of CPI so you can prepare. More importantly, I want to talk about the new single stock short ETF, talk a little bit about what goes on behind the scenes and give you the entire rundown so you guys know everything. Let's get right into it. First off, take a look at the move today after the accelerated downtrend. We bounce off that 4,000 SPX level, actually the futures level on that Sunday overnight. A little bit of retracement back up to the 407 on SPY just to have the further move to the downside. So just to give you a quick look on where we are at so you guys know. First off, when you see a massive red candle like this, a lot of times it's not just a single day or single action move. You might have a brief consolidation, slight retracement, okay, and then you're going to see a continued move to the downside. Now, also on the contrary, when you do see a massive move like this where you break through multiple levels of support, it's very common for the charts to curl back around and want to retest those old levels of support to ensure their new levels of resistance. Because as you can see, we are moving from a short-term uptrend to potentially a short-term downtrend, and they want to continue that move. So over the next week, week and a half, as we await the jobs report and CPI, especially if we close over that $400 level of today, expect a little bit of consolidation and possibly a move back up to that 405, 406 area. Want to hold that resistance before a continued move to the downside. Now let's talk about this AMC short ETF. So this article actually came out July 24th, and once this came out, I just said, listen, this is really opening the gates, okay, for what is to come. So Nike, Nvidia, PayPal, Pfizer, and Tesla all had these issued quite a while ago. A couple things that you need to know about them, okay? First off is this. All these articles talk about the SEC skepticism, okay, how they're against it, okay, they could hurt investors, okay. The one thing that you need to know is they're trying to gear this all towards retail. They want to be able to protect retail. All right, if retail gets into these, they don't understand how volatile they could be, how quick they can move, okay, they can lose all their money, acting as if they really care, but here they are just letting these continue to pass by. So one thing I want to point out as I get into explaining what exactly these are is their leverage single stock ETF in particular amplify the effect of price movements of the underlying individual stocks. So generally speaking, when you look at, okay, just a standard ETF, let's take a look at QQQ, the movement that is occurring inside heavily weighted stocks such as Apple, Microsoft, okay, Tesla, Nvidia, AMD, those are the leading stocks. Okay, so when you see these stocks start to pull down, it's going to pull the QQQs with it. The QQQs are just reactive to the individual stocks that make up. However, what this statement is saying to me is the fact that these single stock ETFs can actually move the underlying stock price. Okay, so keep that in mind. Now here's this article that comes out. Single stock ETFs would let bears bet against AMC, Tilray, and other meme stocks. What investors should know. So first of all, when I read this, the first thing that comes to my mind is, okay, rather than, having to pay these astronomical fees to be able to short the stock, okay, rather than having to try to find locates on these or the complete manipulation of naked shorting, well, now we have another avenue to be able to do this. So the list that's in here, and it's not just AMC, obviously we're covering AMC, but when you take a look at these right here, the first thing that sticks out to me is, one, you're looking at companies that they have some struggles, okay? And I think we all can comfortably admit that these companies in general have a lot of struggles, okay? Some more than others, but they have a lot of struggles. Also, a lot of these, if not all of these companies have really been retail favorites, okay? So the first five, you look at, Tesla, Nvidia, Nike, okay, Pfizer, PayPal, household stocks, that's fine, that's great. Now you're looking at this next bunch and it's specifically geared towards retail. It's the first thing that sticks out to me in this article, okay? Why it's important. A single stock short ETF, aka inverse, works by short selling a stock to create an investment opportunity in an inverse direction to the stock. one can go short on a single stock without having to sell it short. Something I just had stated previously. But here's where things change and get to be a little bit different, and be a little bit more complex. Okay, so first thing as I get into this article, it says single stock ETFs, what to know about these risky new funds. So a lot of these fund advisors have come out and they've talked, okay, and on TV hosts, as well as to other media outlets, and obviously writers, and have said, listen, we're gonna have a hard time trying to sell a single stock short ETF to Mr. Smith or Mr. Jones, who's a 65-year-old retiree, okay, because it's very, very risky. So therefore, this is for complete manipulation, okay, and it's really admitted by stating that single fact. Okay, so now let's get into the details behind this. Single stock ETFs are highly speculative and intended to provide geared exposure to an individual stock. Okay, because of the features of these products and their associated risks, it would be likely challenging for an investment professional to recommend such a product to a retail investor while also honoring his or her fiduciary obligations. It's exactly what I had just stated. Here's where things change to be just a little bit different. Okay, here's how they work. Rather than owning individual stocks, these ETFs contain swaps, which are contracts where two parties agree to exchange cash flows of one asset for another. So let's just take one step further and talk about swaps if you're unfamiliar for what they are. Okay, so like I just stated, a swap is an agreement between two parties. Okay, basically it's done saying, listen, we're going to exchange one asset for another asset. A lot of times it is a cash flow. It could be a little bit different when it comes to what type of currency. Here's where things get to be very, very sketchy. Swaps are customized contracts. Okay, customized contracts traded in the over-the-counter or OTC market privately versus options and futures traded on a public exchange. So therefore, you're creating these single stock ETFs, okay, that contain swaps. So therefore, okay, it's just funds and institutions that are be able to manipulate this between each other, okay, while also manipulating the entire stock price. So not only are they able to continue to short the stock, okay, whether shares are available or not, right? They appear every single day, okay, they continue to have the ability to be able to short the stock. All right. Now they can manipulate the swaps behind this single stock short ETF to not only capitalize greater on their shorts, okay, because don't forget this is magnified, like I just stated, okay, but also if they continue to put pressure into these short ETFs, it's actually going to pull the price down even further. And it states it right here. These contracts magnify the daily exposure of a single stock and tends to juice the returns in one direction or another. I think this is an overall just a complete, oversight of the SEC. And there's a 2019 law, and I forget which article has it in there, but there's a 2019 law that states, because it was passed, that as long as certain criteria is met, okay, therefore they can contain or they can create an ETF, and the SEC really can't say anything about it. And that's exactly what they have done here. So but it's still a complete oversight, and like I said, you're literally giving them even more power, okay, than they have, okay, because now it's going to be a bit harder for retail to be able to fight them. Now don't get me wrong, when I say a bit harder for retail to fight them, don't forget this. Every single time there is a fund, okay, short on a stock, okay, funds compete against each other. Okay, there obviously some funds work together, but funds also compete against each other, right? They want their clientele. Okay, when massive funds get into, and we watch this with AMC, all right, when you watch all the funds pile in back, May, June, okay, so this also does have the inverse effect that while retail might be harder for retail, it also can entice other funds and institutions to get on the long side to be able to squeeze these shorts that are now going to be really over leveraged. But in a time that we're in, it's just like, because margin requirements are going to be tighter, I think this is a huge oversight of the SEC. It's going to take some time to play out. This is only the very, very beginning. Just wanted to give you my take on this, and just give you a basic understanding of exactly what these are. So that's it for this video, guys. I'll see you in the next one.